Every wheel strategy guide on the internet tells you the same thing. Sell puts on quality stocks you wouldn't mind owning. This is well-intentioned advice, but is also dangerously incomplete. Quality is not a screener filter, and wouldn't mind owning is not a risk management framework. If you had applied this logic to Silicon Valley Bank in early 2023, you would have watched your quality holding drop 97% in 48 hours. Investors who avoid these traps don't rely on gut instinct. They calculate. Before selling a single put, they already know the stock's fair value, know their margin of safety, and can confirm with mathematical confidence if assigned shares they are buying at a discount, not walking into a value trap. This is the wheel strategy that most guides don't teach. If you enjoy my videos about investing in US stocks, please like and share my videos and subscribe to my channel. Thank you. The wheel strategy is a two-phase options income cycle built on two core strategies, the cash-secured put and the covered call. You sell a put on a stock you genuinely want to own, collecting a premium up front. In exchange, you take on the obligation to buy 100 shares at the strike price if the stock falls to that level before expiration. If the stock stays above the strike price, the put expires worthless. You keep 100% of the premium and repeat phase 1. If the stock falls to or below the strike price, you buy 100 shares at the strike price and move to phase 2. Now that you own 100 shares, you sell a call against those shares and collect another premium. If the stock stays below the strike price, the call expires worthless. You keep the premium and your shares and repeat phase 2. If the stock rises to or above the strike price, shares are called away at the strike price and you return to phase 1. That's the wheel. Mechanically very simple, the complexity and the edge lies entirely in stock selection. When you sell a put, you are effectively agreeing to buy a stock at a specific price. This means your stock selection decision is not about abstract quality. It's about whether that specific price represents good value, and that is a calculation, not a feeling. Imagine you're running the wheel on a stock trading at $80. Analysts love it. It pays dividend. It's in the S&P 500. You sell the $75 put and collect a $3 premium. The stock drops to $72 and you're assigned with the cost basis of $70. But what if that stock's fair value is $55? You haven't bought a discount. You've bought into a stock that still has 24% more downside to go. The wheel strategy cannot protect you from this. Only a fair value calculation can. By combining value investing with the wheel strategy, you have already secured 3 layers of discount before any potential assignment, forming your margin of safety. Buying below fair value, buying at a strike price below the current stock price, and further reducing your cost basis through the premium received. If you are forced to buy a genuinely undervalued stock, you are not in trouble. You are in an excellent long-term position. Using the SlashTraders proprietary stock screening tools, the entire process from screening to executing the wheel strategy takes less than 10 minutes. Open the bullish value stocks list, sort by upside, and look for upside of 15% or more, which is a meaningful margin of safety. A stable dividend history is not required, but a high yield can boost returns when selling covered calls. You want implied volatility to be higher. A stock with an IV rank of 60 will give you roughly double the premium of the same stock at IV rank of 20. But extreme implied volatility of IV rank above 80% to 90% usually signals a genuine crisis. Use the option scanner to check IV rank, and target range is IV rank of 40 to 70. Target a put delta of 20 to 30, corresponding to a strike roughly 8 to 15% below the current stock price, with approximately an 18% of being assigned. and target 30 to 45 days to expiration. This is the sweet spot where theta decay accelerates. As expiration approaches day by day, here are some trading management tips to respond to stock price movement. If the stock price stays above the strike price, let it expire and keep the full premium, and return to step 1. Stock price approaches the strike price before expiration, around 10 to 14 days remaining. If the fundamental thesis still holds, consider rolling, re-entering at a lower strike with a later expiration. Stock price drops sharply due to financial losses. Redo the fundamental analysis and recalculate fair value before rolling. If assigned, proceed to step 5. Your actual cost basis is strike price minus premium received. If you sold the $77.5 put for 20 cents, your cost basis is $77.30. If fair value is $99, you hold a stock worth $99 at a cost of $77.30. A 22 margin of safety established before you sell your first cash secured put. Continue selling covered calls using the same framework of delta 20 to 30, 30 to 45 days to expiration until your shares are called away at a profit. The greatest risk of the wheel strategy is when the stock drops significantly below the strike price. In that case, two management rules help minimize losses. Reassess the thesis, not the chart. After more than 20% drop, recalculate fair value with updated earnings projections. If still significantly undervalued, hold and continue selling cash secured puts. If the business has deteriorated, exit and take the loss. A strategic loss is far better than a hope-driven hold. Never over-concentrate. Keep each position to 2 to 5% of the portfolio. Even a 50% loss in a single stock will only impact the overall portfolio by 1 to 2.5%. Understand the 4 characteristics of stocks suited for wheel trading. Trading below fair value, stable or growing earnings, good options liquidity, and moderately elevated implied volatility. And you can confidently start using the wheel strategy to enhance long-term investment returns.